Good evening, everyone. I hope you are doing well. So, in this video, we are going to deal with adjusted present value. If you are new on this channel or you have never subscribed before, you are encouraged to subscribe on this channel so that you cannot miss the next videos, because this is a channel that share with you some important key points in accounting field and other professional courses. So many people ask themselves how APV works. What is APV? How to compute APV? When it does this, will be used. So I know in this video you are going to get some package on your confusion, as you always ask yourself. So let me first explaining the meaning of APV. Usually many people uh, many people are familiar to appraise their investment if they are viable using net present value. So it means that they account their investment as they are financed by or equity owner. But this adjusted present value, it's an investment appraisal techniques that consider the financing effect on the project. They firstly compute NPV as the project is financed by equity only, and then incorporate the side of debt effect on the project so that they can conclude whether the project is viable, while they have considered the effect of debt financing. So as you see in this worksheet, I have tried to arrange and put online some more key points, some more key definition that can help you to understand well the meaning of adjusted present value. So as you see here, adjusted present value is an investment appraisal techniques that consider the financing effect on the project. Meanwhile, in other words, it is used if a new project has a different financial risk. That is to say, they have combination of debt and equity in their capital structure, so that they use them to finance their project on hand. This means that overall capital structure of the company can change, which can lead to incorporation of debt into their capital structure, leading to verification of project or appraisal of the project on hand using both and all equity finance, the APV, and the debt finance also incorporated in those NPV that are being calculated to make it called adjusted present value. So the following are steps of computing adjusted present value. Firstly, you determine the base case NPV of net present value of an agile business. So as I told you, this is verification or appraisal of your project, whether they are viable, but you take it as they are only financed by equity instead of considering finance effect. You firstly compute the net present value of your project as they are only financed by equity. And then the second step is to determine the issue cost and tax benefit on the issue cost, if any. So whether you have been decided to use adjusted present value, you determine the issue cost if they are there, and then you determine the tax shield or tax benefit on those issue cost of debt if you have been given that the issue cost attract tax benefit. So thirdly, you determine the debt tax shield To get this debt tax shield, first you compute the interest payable on the debt taken. Understandably, you take the gross loan amount, then you multiply by the interest rate, and then those interest rate must be multiplied by tax rate so that you can get tax shield, and then after you compute the present value of tax shield. You normally use annuity when the interest rate is paid as a constant amount each year. You can use present value interest factor annuity when there is fixed interest rate. It means that your interest must be paid in equal amount each year. And then the last step, which is step 4, you compute adjusted present value by taking base case NPV plus present value of tax shield of the interest on debt as you computed, and then you raise the issue cost, both issue cost on equity or issue cost on debt. Whatever you have been given, you must deduct it from this base case NPV, which was calculated using cost of and/or equity financed project, or equity of uninsured business. Uninsured business are those business that don't use debt in their capital formulation. Okay. Here is an example that will help us to understand well how this works. This is an example taken from somewhere to help us understand well how to compute APV. I will try to go step by step so that you can understand how it works, how you can compute it, and the reason why you use this to appraise your project, whether they are viable or not. It can help you to make an informed decision so that your project can be profitable in next time. So this is an example saying that compute the adjusted present value for a new project with a required rate of return of 18%. The project generates 9 million US dollars, 11 million US dollars, and 12 million US dollars, and then 13 million US dollars over a period of 4 years respectively. Depreciation charges on machinery are at 4 million US dollars at the end of each year. You see here they have been calculated the amount of depreciation. No need to calculate the amount because you have been gotten the already calculated amount. The financing required is net of US dollars 16 million for machinery. So of course, this is the initial cost of the machinery, which also going to be raised as the net amount needed. Financing is 40% from equity and 60% from debt. Of course, 40% of these 16 million US dollars is from equity, while the rest 60% will be raised from issue of debt. And then equity issue cost is 6%, means that 40% is the net of issue cost, and debt issue cost is at 3%, means that this 60% is net of issue cost of 3% of the required amount. Then the corporate tax rate is at 40%. Interest is charged on debt at 16% for 4 years. You know here interest is charged on debt, so you charge this interest on gross loan, not on net loan. You must firstly gross the amount of loan so that you can get the full value of amount borrowed from the bank after incorporating this issue cost uh, to get the gross amount. You here have been given a hint that interest payment is not a fixed amount. Put a key point on this. If interest payment is not a fixed amount, firstly, you understand directly that you are going to compute uh, loan amortization schedule so that you can get the amount of interest paid each year. So everyone understood the requirement of this. They are requiring us to compute the adjusted present value for this new project. So here is some answers as I have worked on. We will try to understand this step by step. Okay. Here is answers. Firstly, as you know, they have told us they are 4 years on hand, which start from year 1, year 2, year 3, and year 4. And then you must write year 0 as where the project is going to be started on. Okay. Here is details: year 0, year 1, year 2, year 3, year 4. Amount are in 1,000, of course. Then, as you see, they have given us cash flow before tax. You see here is a cash flow before tax. Sorry, here I have typed tax twice. Okay. In year 1, in year 0, they told us the initial amount is a net of 16 million US dollars. Here the amount are in US dollars, not in Rwandan francs. Amount are in US dollars. Let me check this. Amount are in US dollars, not in Rwandan francs. Okay. As you see, I've reserved the amount are in thousands. Okay, here we have cash flow before tax. Year 0 we have 16 million, year 1 have been given 9 million, year 2 have been given 11 million, year 3 have been given 12 million, and year 4 we have been given 13 million. So this is the amount before interest, tax, and depreciation. Okay, as you know here, these are the cash flows we have been given. The project will generate in future time. So what we do here, we raise tax because we have been given a tax rate of 30%. We must firstly compute tax on these cash flows. So you will take this 9 million times 13%, which will be equal to 2,700. And then here is 11,000 multiplied by 30% will be equal to 3,300. 12,000 times 30% will be equal to 3,600, and then 13,000 times 30% will be equal to 3,900. And then we can compute the cash flow after tax. Cash flow after tax, obviously we will take this cash flow before tax, then deduct this tax as computed. So in year 0 there is no change because no tax has been paid. Year 1 will remain with 6,300. Year 2 will remain with 7,700. Year 3 will remain with 8,400, and year 4 will remain with 9,100. So what we do here, as you see, we have been given a depreciation of 4 million US dollars. So because I have not deducted depreciation before taxation, what I do is to compute a tax shield on this depreciation, and then I add back this tax shield on this amount after tax. So here is working one, as you see on this right side. On here on working one is to compute tax shield on depreciation. You see that tax depreciation per year is 4,000, because I have been reserved 3 zeros. Amount are in thousand. Here is 4,000. The tax rate is 40%. So what I do to compute the tax shield that will be gained each year is to take this amount of depreciation per year, then multiply by 30% as a tax rate, so that I can get tax shield of 1,200, which will be taken as tax shield on depreciation. So this 1,200 will be added back to the amount after tax. This cash flow after tax, I have to add this 1,200 on these cash flows after tax. So after adding back this tax shield on depreciation, I can now get the net cash flow to be discounted. Net cash flow, as you see, obviously year 0 there is no change, but year 1 will be increased to 7,500. Year 2 will be 8,900. Year 3 will be equal to 9,600, and year 4 will be equal to 10,300. Then this cash flow must be discounted so that they can be taken as the amount in present. So the discount rate, as we have been given, is 18%. This 18% is the rate that are going to be used to discount these cash flows. So discount at rate of 18%, year 0 there is no change because the amount are in present. That's why we multiply 1.000 to make no change in value. While year 1, as you know, we compute the amount of this this is the interest factor, discount factor, sorry, to be multiplied on this cash flow so that they can be discounted. This is the discounted factor at rate of 18% year 1, and this is at rate of 18% year 2. This is at rate of 18% year 3, and this one is at rate of 18% year 4. And then the last thing to do here to get the present value is to take this cash flows net cash flows, then multiply by these discount factors as computed. So year 1 still no, year 0 still no change. It is still 16 million. Year 1 it is 16 million. Then year 1 will be equal to 6,353.932. Year 2 will be equal to 6,391.84. Year 3 will be equal to 5,842.856. And year 4 will be equal to 5,312.625, and then we sum up these values as present value of the cash flows to get the NPV, best case NPV of this project that have been computed as they are financed by equity only. The best case net present value is equal to 7,903.255. So this is the part one of computing adjusted present value. So the next step or part of computing this adjusted present value is to compute the financing side effect. Okay, financing side effect of the